702 Finance Feature.
In our finance feature for today, a topic that some of you have asked for, and that is talking about those that work in the gig economy and how we need to rethink credit worthiness. We're joined by Richard Eberlein, who is Executive for Growth and Engagement at Weaver Fintech. Richard, welcome to the show. Thank you for joining us.
Thank you, Reba. Thank you for having me on your show today.
So when we say gig economy, are we referring to your freelancers or people that are not sitting in a permanent role that has retirement and all of these benefits?
Yes, we are. And if we look at some of the stats, there's about 1.9 million informal businesses, and that equates to about 3.6 million workers out there who are what we see as the informal sector.
So when we look at where we've been, let's say 20, 30 years ago, how were those that are in the formal sector looked at when it comes to credit? I mean, I'm in the gig economy, and so many people say, "Oh, the banks hate us."
So if we go back 30 years, it's always a good point. I look at how I started building my credit record, and I've just gone over 50. And in those days, we would go to a retail store. It used to be Edgar's in those days, and get your first retail card and pay it off and try pay regularly and build your credit. And at those days, you know, the credit bureau would have our data and be able to build a credit record because of all the bank accounts. If we look at the informal sector, very few of those customers have bank accounts, and they are working with cash. They're moving cash around. So we're very fortunate at Weaver Fintech, where we have multiple products. One of them is Pay Just Now, which is a buy now, pay later solution. And we're able to build up alternative data on our consumer there. So that can be shopping behavior. It can be purchases of data and airtime. It can be insurance payments. So it's not looking at your normal credit bureau data. So we're very fortunate to have that rich first-party data. And with that, we can build scorecards to be able to responsibly lend into this informal community.
So what are some of the things that people can start to do? I still advise the young people around me to say, start building your credit. Make sure you pay it off quickly. Look at where the retailers that you go to quite often and already use. But the trick is you must pay quickly. So I'm still in that era of go open a clothing store account or a TFG or whatever else is there.
So I think some of the challenges that these 3.6 million customers have is they can't even open an account at a retail store. So for me, the recommendation would be there is to go get a cell phone contract. Even if it's a pay-as-you-go contract initially, stick with the same cell phone contract, pay it monthly so that they can see your payment behavior there. If you can get a contract that's a 12-month contract or a 24-month contract, then get that and pay that off over time. Those small nuances and data points that we're able to pick up and other businesses are able to pick up will start building their credit record. And then in time, they'll be able to open a store account and from there be able to get credit with lenders.
You were mentioning things like insurance. In the picture of credit scores and things like that, do you find that many people in the gig economy actually do take out insurance, considering for many it can feel like a grudge purchase?
It is a grudge purchase, and we look at that often as how do we encourage our consumer to take out insurance. Often we see it as a family thing. You know, we've got at FinChoice, we offer up to 19 family members being covered under one policy. And we find a lot of our customers are taking it for themselves, but also then putting their parents on it. So there's where we're looking after our parents, and as we all move on in age, our parents are moving on in age as well. And it really is important to get those policies in place, maybe not for yourself, but for your parents and for other members of your family. And with that, paying regularly, we can again see that your payment behavior is that you've got money coming in on a regular times. Because if you are not formally employed, you don't have a specific payday. And one of the risks that we would look at normally is that without that specific payday, you're not able to meet your financial needs. But if we can see that there's this continual payment cycle happening on time, then we can see that behavior, and through that behavior can work out what affordability you would have to be able to take a shorter term loan. With a lot of our customers, when we onboard them, is we'll bring them in on a loan growth strategy. We'll start them off on a 3-month facility to see that they are able to fulfill their repayments, and then move them on to a 6 and then a 12-month loan. Always keeping in mind that we are a responsible lender, not wanting to overextend the consumer to get them into a position that they're not able to make those payments. Because it's critical, once you start missing payments, it is then registered with the credit bureaus, and over time you will not be able to get credit. So it is important, and you said it, that you pay on time and keep up with your payments to ensure that the credit score is kept at a very good rating.
And I think, Richard, thank you for reminding, especially those that are small business owners who mix their personal and business finances. They don't look at that side. They need to look at what's happening in your bank account and your statements. Thank you for joining us on our finance feature.